All right, Maneesh Dangi joins us. He joins us in his new avatar in his independent capacity. So, Maneesh, fantastic to have you back. Thank you for joining us. We are talking to in your new avatar where you're starting your new venture. So, good luck with that. So nice to see you, walking on the entrepreneurial journey.
Thank you very much. Thank you, Nikunj.
Your market view of late is one that of caution. Why is that? When economy is unleashing itself and when we are on a cusp of a new economic recovery, why do you think that best of the gains for the moment are behind us?
Yeah, so Nikunj, every time we've talked since end of March 2020, I had a clear view of how markets were misreading macro. Macro was extremely supportive of risk assets, most specifically equities, and was leading the markets in directions that we all love and which is higher. We made lots of returns since then, and most portfolios are sort of, if you invested then, are up by 100 to 200%. So what now? I think sort of environment is somewhat muddied now. Valuations are that expensive. You can clearly see pockets of bubbliness in small caps at least. Supply of equity is actually huge, not just in India, but across the world. In India's case, you'll have $35–40 billion of unprecedented supply, and flows aren't too much, to absorb this sort of supply. I don't expect between mutual funds and FIIs together more than $20 billion worth of inflows. Also, macro is somewhat muddied, in a sense that you've seen our currency sort of bottom about 2 months ago, and it's sort of backed up. So as such, dollar is appreciating, which is somewhat of a risk-off indicator. Central bankers are pulling back. You've seen emerging market countries actually hiking rates, your Mexico and Russia and Brazil. And, Fed beginning to talk cautious. They sort of talk both sides, but, it is no more one-sided view from Fed. Maximum growth momentum is behind us, I understand and appreciate this, that, growth is going to be super strong over the next 1.5 years, but market sort of notices the delta, and delta is not going to be positive at margin. In a sense, the derivative of growth is going to slow down. As such, most hard data is surprising on the lower side. And then in this sort of backdrop, Nikunj, India hasn't done too well. Let's accept it in managing this crisis. Our fiscal response has been weak. COVID devastation has been substantial for both household finances and healthcare. So when I look at the whole of the picture, in the backdrop of what stocks have already done, I think it makes sense to sort of pull out and rethink and review things and come back. Stocks in long run always do much better than everything else, including cash, gold, and bonds. It's just that given that we've had huge rocketry of sorts in last 1.5 years, I guess it makes sense to be somewhat cautious. So that's the point I'm coming from.
Manish, if liquidity is abundant, whether it is in NFO garnering 10,000 crore or the kind of response which we are likely to get for Zomato, or suddenly what is happening, with global central bank balance sheets, even if markets are expensive and macros are bad, the compulsive nature may keep the market afloat.
No, that's true. That's true. Someone actually a few days back, when I wrote a small memo and why I'm turning cautious, one of a buy-side guy told me that only God can predict the top of the market. And I'm aware of this, that, this frenzy can go on. You've seen this happening in the past, and it can go on for longer. But it's just that, I'm a macro guy, and, in a sense, I only stay invested, and I advise people to invest only when both valuations and macro are supportive. So I've made this argument with you, Nikunj, many times. Remember in January, in November, March, every time people talked about valuations being expensive, I made this argument that macro is far too supportive, and let's not let's be somewhat dismissive of valuation at the moment. But then when the winds are changing now, as I said that the macro is taking a bit of a turn, okay, a small turn albeit, it sort of makes sense to be cautious. It is true that the liquidity is huge. It's just that the run rate of liquidity or the second derivative of liquidity is actually plunging. So you've seen credit impulse, in China sort of plunging for last 5-6 months, and you see what has happened to commodities because of that. Commodities are down. Pretty much all industrial commodities are down. Now you've seen sort of in Europe and US also, credit impulse is actually at margin beginning to go down. Its impact would be seen sometime in future, maybe 2 months out, 3 months out, and it would be seen in stocks as well. So I guess it's not a coincidental indicators. Macro sort of try to predict. As I said, if dollar is appreciating, and in this case, again, US Treasuries have come off, but they are hinting at something which perhaps equity markets won't like. They're hinting that perhaps you're not going to get great growth in long term. Your real rates in US have actually plunged, which essentially hints at the fact that perhaps for very long you won't get this rock solid growth. So coincidentally, one would argue, as you're saying, that there's lots of liquidity, frenzied buying for a lot of these stocks, like what we've seen in the last few days. But I guess at margin, my job is to sort of predict what lies a month or 2 months out, and that's not looking good to me right now.
One basic argument, Maneesh, is that commodity prices are down and dollar is strengthening. That's bad news for India because we are a dollar and a crude economy. But if one looks at the balance sheet of the US Fed, we know that there is a hole, and that hole is not going to, and the hole is a big fat hole, which means eventually dollar is headed lower. If dollar is headed lower, commodity prices should go higher. Is that a valid argument that if commodity comes back, a lot of pain points will be taken care of?
So commodities are pivoted to China, in a sense, how most stocks are pivoted to Fed balance sheet, or let's say G3, G4 balance sheets. Commodities are pivoted to China deflation. So you cannot sort of dissociate commodity price direction to how Chinese economy is sort of moving. And we know as a matter of fact that Chinese economy has slowed down quite substantially over the last 6-8 months. Also remember that China is ahead of global macro cycle by 6 to 8 months because sort of they tamed COVID much ahead of everyone else. And so to that extent, China is giving you a glimpse of how rest of the world would look like, in 4 to 5 months' time. Now, as far as dollar is concerned, I understand that Fed has bloated balance sheet, and at margin, they would continue to supply a lot of dollar, but the overall momentum for dollar supply would reduce. Fed would at some point in time, given the inflation backdrop that we've had, you would begin to see taper. The US economy is absolutely bombastically doing very well. So, if you were a Fed chair and you were presented with this data that, you're going to grow at 6.5%, 7% this year and 4.5% next year, in this wake of, strong data, you also are told that, your houses are gone up by 14, 15%, and your CPI print is, multi-year high at 5% for 2 consecutive months. I guess, it's not a rocket science for you to sort of say that, okay, let me step back and see how things play out, So my sense is that it is fair to assume that many central bankers, and more specifically US, which has done so wonderfully well in terms of reviving its economy, that it makes sense for them to sort of take a pause, and which is why now taper is around the corner. Okay, people have actually sung off taper, for 6-8 months now, but I guess now it's with data in retrospectively looking at how inflation, house price inflation has all played out. It sort of makes sense for Fed to take a pause. So my bet is that, early 2022 or end of 2021, you will begin to see taper. Now, there is absolutely no case whatsoever as it happened in 2013, emerging market countries and currencies and stocks are not going to blow up because our balance sheets are much, much stronger. India has like in excess of $700 billion reserves, once you account for forwards. So our currency is not going to blow up. It's just that, if the delta of liquidity on dollar side turns weak, dollar would begin to strengthen, and which is what you're seeing now, Nikunj. So this argument that, dollar will weaken, I presented this many times over last 1 year, but now we know as a matter of fact that dollar is not able to break down below a certain point. And it is sort of finding a lot of support at 88, 89, 90. And it's sort of coming back up again and again. It's suggestive of something that markets are looking at something new and something more. And we ought to take care of that, and we ought to take notice of it.
Maneesh, hi there. Good morning. Assess the liquidity situation for us, because the buoyancy of liquidity has definitely kept the Indian markets going. But do you believe that if there were to be a U-turn in the foreign fund flows, that domestic institutional flows would be strong enough to support the market in the absence of liquidity from FIIs?
Look, as far as foreign funds are concerned, there's a bit of a rerun happening of what we saw after GFC. You had a huge wall of money coming in and then drying up, as your macro worsened. Remember 2011 was muddied because of high inflation and higher rates in India with lower growth prospects. And that led to a situation where overall fund flows began to decline. And they never recovered since then. It's only briefly, once or twice, we had big flows. Last year, we had very strong flows. Okay. Some of it was because of the unwind of, the COVID unwind, one would say, because, foreigners sold large amount of money, stock. But then, you're starting to see your last 5-6 months, the flows are reducing. It's not just in India, across the flows are drying up because remember, the foreign flows are looking at a variety of things, but most importantly, the currency and the country's macro. And they're not looking at country's macro as strong. Again, from a relative standpoint, you're seeing US actually going past the pre-COVID run rate of output, whereas India is actually quite a struggle right now. We are sort of, it'll take years and years for us to go back to the pre-COVID output level. So foreigners are actually are at margin cautious, and therefore you're not seeing big money coming in. Also, the local money, remember this started, in the wake of, Modi's victory, large amount of money started to flow in mutual funds. It got accelerated after demonetization because, people had a lot more cash. And as such, because of low inflation, property markets were not doing well. So, you saw a lot of push into the financial savings, but then that began to slow down about a year ago, and it's not recovered fully. So to argue that, domestic investors would be able to plug in to absorb the sort of supply that we are seeing, I think it's sort of misplaced. The supply demand after a long time on equity side is matching what we've seen in bonds for a long time. Supply has always been higher in Indian government bond over the last 10, 12 years versus demand. I'm seeing that happening. You have 30, 40, $45 billion worth of supply of equities, whereas the domestic investors, won't get more than about $8-10 billion. And foreigners would go back to the run rate that we've seen over the last 10 years, which is more like $10 billion. So last year's foreigners' money, which flowed in the country to the extent of, I think, $30 billion was somewhat of an anomaly, which we saw everywhere in the world, but it's drying up. So I guess, let's not get excited about flows too much. In a sense, flows are relatively smaller today than we've seen in the past.
Do you believe, Maneesh, that as we see gradual normalization of the economy, that can lead to a taper in the overall bond buying program, that coupled with perhaps a strong job market, and that could potentially lead to a tightening of bond yields?
Yes, absolutely. So, I would be surprised if treasury yields, both in India and US are not substantially higher from where they are today. But let's take a sort of small step back. USTs, everyone was convinced that they will go higher, but they sort of wound back. Fundamentally, because market thinks that inflation is transitory as Fed thinks. But I think the large reason why UST backed off was because of technical factors like US Treasury unwinding the cash, leading to low supply of paper in past couple of months, along with, of course, this, skewed positioning by investors in favor of, short US Treasury. So, which is why you had a unwind of US Treasury yields, But I guess, given the growth inflation setup that you have in US, rates are certainly going to head higher. Last 5 years on an average, US treasuries have traded at 2%. So I wouldn't be surprised in about a year and a half time, we get to at least 2%, if not higher. Now, as far as India is concerned, India has a clearer case of higher bond yield. Indian markets are overwhelmed with supply. The total supply of bond is actually twice over last 2 years, almost 18 odd lakh crore of run rate of supply of government bond between state governments and central government. There's absolutely no visibility of even half of the bond being demanded by market. So as and when RBI shows the inclination of letting rates sort of move up, right now, remember, though it is not said very clearly, but India is a clear case of yield caps right now, and it's a dangerous experiment being run by RBI. They're not letting the 10-year bond move up substantially. If you allow market forces to work on 10-year bond, 10-year bond would be 675 right away. So to that extent, I think the case for Indian government bond to head higher is far easier, because the case of India's inflation sustaining higher and India's total bond supply overwhelming markets is much, much higher, and therefore it points to higher and higher yield throughout next 1.5 year. The case for UST is a bit nuanced. As I said, I still think that, I have a strong view that USTs will head higher. But, you could argue on both sides. In India's bond case, it's almost given that, bonds will head higher once this so-called soft yield cap actually goes away from RBI.
So Maneesh, that means for next couple of quarters, 2-3 quarters, rate sensitives will underperform and dollar sensitives will outperform?
So yes and no. I mean, in a sense, if rates, our Indian rates are actually pregnant with sort of up move, because it would have already happened had RBI not been there. So to that extent, all of us are well aware of it, and which is why you're seeing that outside of 10-year bond, rates have already moved up. This movement, upward movement in interest rates in India, by the way, is happening in a relatively weakish macro. So remember 2011 again. Basically, what's happening in India is that our recovery is not complete. Our output gap is still substantial, but because of high food prices, high crude, and sort of shortages across the economy, our inflation has been somewhat relatively higher for last 1.5 years, rather 2 years, almost 5.5% inflation. So, Nikun, it's a nuanced argument that rates are heading higher because India is experiencing elevated inflation because of supply side issues. Okay, and which is actually not a very good sign generally for everything, rate sensitive or otherwise. But okay, even then, if you were to think whether dollar is going to appreciate at margin and rupee will weaken, what you're seeing is that, markets are sensing and smelling it again, and which is, I think I heard you comment on IT. Anything which is somewhat dollar sensitive, let's say, or which priced in dollar, what is priced in dollar? Commodities are priced in dollars. So while, everything that JSWs and JSPLs of the world sell in India, but it's basically dollarized balance sheet. Same thing for ITs to a very large extent for pharma. So you're right that if it on just this vector, I guess, there would be some tailwind for these dollarized balance sheet versus, many local balance sheets which sort of are going to struggle because of a little bit of a stagflation scenario that India is witnessing.
So by and large, your advice is that stay on cash, because the bonds will rally, bonds will go higher, or yields will go higher, and equities will come down. One is better off staying on cash or putting money in, let's say, a fixed deposit.
No, so okay, it's like this, by the way, stocks almost always, historically sort of outrun cash substantially and outrun bonds substantially. So if you're a very long investor, you don't care, just put your money in Nifty index and forget about it, okay? If you're a macro guy like me, who sort of like to extract excess equity risk premia by sort of placing bets, sometimes by being overweight, sometimes with excessively underweight. For you, there's an opportunity to sort of, having made 100 to 100% returns over the last 15, 16 months, pull out, and then sort of go to mountains, relax, rethink rather. There's a lot of bubbliness in the market right now, which we all know. These Twitter heroes are actually recommending stuff and, realizing them instantaneously. So, and a lot of people are getting trapped. So my advice to an average investor is that relax right now. You're not going to miss big time anything, by staying out in markets for a couple of months. Even if you're a compulsive investor, just put money in Nifty and forget about it. Don't take active call right now. Take your time out, think about markets, themes, stocks, because everything has run up like crazy over last 15, 16 months. I think, markets are going to be much more nuanced now, Nikunj. So it's time to sort of take time off and, rethink. For a person like me, I've actually in the last 7 days, I've withdrawn from pretty much all my friends who manage my money in small cap funds, The next bias would be that my sense is that small caps and mid caps would underperform mega caps. And, as such, over last 6 months or 8 months, I think, markets would struggle. So I'm going to sort of take some time out, rethink, and, then redeploy. But yes, for broad, big picture run that I've argued with you, that the glorious decade for India, that's still my thesis. It's just that this intermittent, soft patch that we are hitting right now, it's a time to sort of rethink and, then redeploy money according to what you think.
Thank you, Maneesh, for taking time out and sharing with us your thoughts. It's been a pleasure interacting with you and understanding what your view is on the overall bond market, equity markets, as well as the liquidity situation at hand.